Hey everybody, we are well into earnings season. I want to talk about earnings from one of what I consider one of the best bank stocks to buy for the long term right now, and that's Ally Financial. Before we dive into the latest numbers and why I like it so much, take a minute and check out the link you see on your screen, fool.com/Frankel. Get some of the best stocks to buy right now from the Motley Fool for free. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So let's go ahead and dive right in. I want to share my screen for just a second. Hopefully you guys can see that okay. So these are just the headline numbers. I'll start with this. Earnings and revenue growth were pretty strong. You can see earnings per share of 95 cents on an adjusted basis in the third quarter, compared with 83 cents a year ago. That's a pretty nice gain. Return on equity rose significantly from 9.9% to 11%. Um, Pretty impressive growth in tangible book value, in common equity per share, which is just book value. The efficiency ratio, which for a bank efficiency ratio, lower is better, increased significantly. Good expense controls, things like that. And revenue itself rose by about $100 million, a little more than $100 million for the year-over-year period. On an adjusted basis, it was more flat, but still pretty solid numbers all around. So let me get into some of the more important things to know about what's going on with Ally right now. So Ally is primarily an auto lender. They were a spinoff of General Motors in the wake of the financial crisis. So auto finance is by far the biggest part of their business. And it looks pretty impressive just over the past, 7 years. This is just the rate of auto loan applications they're getting, steady growth right there. The average loan they're originating right now is about a 10.5% interest rate. They're being more selective on applicants recently, which I'll get to that in a little bit. And they also have a pretty big deposit platform. The deposit growth has been very, very impressive. Ally's online banking platform is relatively young. It's growing very fast. You can see it went from 1.4 million customers in 2017 to 3.3 million customers right now. So really impressive. $141 billion of retail deposits. That pretty much covers its auto lending business. We'll get to the balance sheet in a second. But really, really impressive. They also have credit cards and home loans, but auto lending is by far the number one part of the business. Now, the stock kind of took a little bit of a hit after earnings, and here's why. People are really worried about credit quality, especially in the auto lending business. People are paying more for cars than they ever have before. During the pandemic years, when there was a car shortage, people were overpaying for cars, and that led to people kind of being a little bit overextended. And with the economy kind of softening recently, there's a lot of justifiable worries about people being able to pay their bills. So you can see for the past few quarters leading up to this one, the net charge-off rate from Ally's business kind of started to decline. It trended downward a little bit. From the first quarter to the second quarter, went from 2.27% to 1.81%. So things were moving in the right direction. And in the third quarter, it kind of went the opposite way. If you look over here, auto loan delinquencies have trended upward for 2 quarters in a row now. And that's just kind of giving investors a little bit of worry. Now, Ally has plenty in reserves, especially for the auto loans. They have about 3.8% of their auto loans balances in reserves to cover potential loan losses. So they're doing okay. They have plenty of money in the bank. The delinquency rate isn't anything that would, or the charge-off rate, rather, isn't anything that I would consider alarming just yet. But that's a trend that definitely should be watched and is why the stock reacted negatively to the earnings report. It's not the numbers themselves. It's, worries about what could happen. So because of this, Ally is taking steps to kind of, tighten up credit recently. They kind of laid out a bunch of different trends they're doing in their earnings report. Fewer approvals for lower credit tiers, higher pricing for lower credit tiers. They're requiring proof of income and employment for more borrowers, meaning making people prove that they can pay their loans back, which should be done all the time if you're asking me. You know, limiting the monthly payment size they're approving, not loaning in negative equity situations. If someone owes more on their trade-in than it's worth, that creates a situation where people can get over their head in debt, and limiting approvals for people that don't have a big credit history. And you can just see over the past couple of years, the average FICO score of approved customers is up significantly. The average yield from loans, and that's more of a product of the interest rate environment, is up by almost 2 percentage points. And the overall approval rate, and this is the significant one, is down from 35% to 28% of applications. So Ally is approving far fewer applications than they were a couple of years ago in an effort to try to really kind of focus on the most qualified borrowers and keep, over the long term, keep that net charge-off rate in a manageable level. So just looking at the auto finance business, I mentioned that the yield was pretty high, 10.54% average yield from the auto loans that they're originating now. Very, very strong interest rate trends that should help as rates come down, as I'll discuss in just a second. But they have another kind of really interesting part of the business that I feel like the market's really overlooking, and that's electric vehicle originations. Now, a loan to an electric vehicle borrower and a loan to a internal combustion vehicle borrower, that's the same. It's an auto loan. It's backed by a depreciating asset. It's the same thing. EV leases are different. When an electric vehicle is leased, the leasing company gets the tax benefit of it, not the person who is driving the car. When you buy an electric vehicle, it can qualify for a tax credit if it meets certain criteria. So Ally gets a nice little income stream, and you can see lease EV tax credits recognized. In the third quarter, it was $179 million. That was almost double sequentially, and this was barely anything for the company last year. That's more than double all of its 2023 lease EV tax credits combined that it did in just this past quarter. So that's a fast-growing part of the business, something that's really worth watching going forward, especially as the EV adoption trend continues. So a lot to like there. I want to quickly go and talk about why I like this in a falling interest rate environment. So far, Ally's net interest margins have not been impressive in the past couple of years. You can see down at the bottom of your screen right here, 3.24% a year ago, 3.27% last quarter, 3.22%, in a pretty tight range. So the key thing to know is Ally's average yields from its loans have climbed significantly. You can see up here, a year ago, the average yield from Ally's auto loan portfolio was 8.16%. Now it's 8.99%. And that's just going to increase because, remember, I've said the average loan that they're making right now has about a 10.5% interest rate. So the average interest rate for auto loans is going to continue to increase for at least another few quarters, unless the interest rate environment really takes a dive. But that would actually be a good thing, because if you look down here, that $152 billion of customer deposits that Ally holds they're paying an average interest rate of 4.23% on. Now, as interest rates come down, as if the Fed decreases rates by another 150 basis points over the next year, as is currently the expectation, I would expect this deposit interest rate to fall accordingly. Meanwhile, because these auto loans are all being originated now in the current interest environment and are going to be on the balance sheet, the retail auto loan yield is going to stay the same or get higher, while the deposit cost is going to go down as interest rates climb or interest rates fall. And you're going to see this net interest margin, which is kind of, think of that as the bank's profit margin. You're going to see that start to increase substantially as rates come down. Now, remember, the Fed didn't start cutting rates till almost the end of September. That was the very end of the third quarter, so that's not at all reflected in this deposit cost here. Ally's already lowered its interest rates on savings accounts, CDs, and things like that, as has most of the banking industry. So even in the fourth quarter numbers, you're already going to start to see that number come down, and net interest margin could really be a big beneficiary. So I think this was a good quarter. I am going to be watching the net charge-off rate closely. I think Ally's taking very good steps to keep it under control. They have plenty of money in reserves. They have more than double the money in reserves that the net charge-off rate represents right now. I think that the EV business is an overlooked part of the company, and that I think that net interest margin is going to climb significantly over the next couple of years. I think consumers are going to be a little more resilient than the market seems to think. So that's one reason I'm bullish on a consumer lending company like Ally. But I'd love to hear what you think. Leave me any questions or comments you have. I'll do my best to respond individually. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.